You're about to discover why everyone who's been telling you to stack and never sell is setting you up for financial devastation, and why I, Milton Friedman, spent my entire career warning you that markets don't reward blind faith. They reward strategic intelligence. In the next few minutes, I'm going to walk you through the exact warning signals that will tell you when the silver market has reached its peak. And if you stay with me until the end, you'll discover how to protect the wealth you're building right now before the inevitable crash wipes it away. So before we dive in, do me a favor, hit that like button, subscribe if you haven't already, and tell me in the comments where you're watching from. Because understanding when to exit is just as important as knowing when to enter. And most people will lose everything because they never learned this crucial second half of the strategy. Here's what nobody wants to admit about market cycles and why your silver stack means nothing without this knowledge. Listen, I'm sitting here in my study in 1995, and I need to tell you something that's going to sound harsh, but is absolutely essential for your financial survival. I've spent decades studying monetary systems, market cycles, and human behavior under economic pressure, and what I'm about to share with you contradicts everything the precious metals community tells you. But it's the truth that separates wealthy investors from those who watch fortunes evaporate. Markets are cyclical. They always have been, they always will be. This isn't pessimism. This is reality grounded in centuries of economic data. Silver, gold, commodities, stocks, they all move in waves. They rise, they peak, they fall, they bottom, and then they rise again. And here's the part that should terrify you. Every single person who tells you to buy and hold forever is giving you exactly half of a strategy. They're telling you how to get on the train, but they're conveniently leaving out the part where you need to get off before it derails. Let me ask you something painful. Are you really prepared to watch your account balance climb to heights you've never imagined? $50,000 and $100,000, maybe even $500,000, and then watch it all disappear because you didn't know the warning signs? Because that's exactly what happened in 1980, and it's exactly what will happen again. In 1980, silver hit $50 an ounce. People were euphoric. They were convinced it was going to $100 to $200. They held through the peak, and then they watched in horror as silver crashed to $10, then to $5. It took 31 years for silver to recover to that $50 level. An entire generation of investors had their wealth frozen in time. Now you might be thinking, but Milton, you've been telling us the fundamentals are strong, that we're heading into a massive bull market. And you're absolutely right. I have been saying that, and I meant every word. The fundamentals are strong. The monetary environment is deteriorating. Government spending is out of control. The debt is unsustainable. Silver is going higher, much higher. But here's what your emotions don't want to accept. Strong fundamentals don't prevent corrections. They don't prevent crashes. They don't prevent market cycles from completing. The people who build generational wealth aren't the ones who buy and hold through complete market cycles. They're the ones who buy low, sell high, and then have the patience and discipline to buy low again when the cycle resets. This isn't market timing in the gambling sense. This is understanding market structure, recognizing pattern completion, and having the intellectual courage to act on that recognition even when your emotions are screaming at you to hold on for just a little longer. I need you to understand something about human psychology that I observed throughout my entire career. The most dangerous moment in any market isn't when prices are falling and everyone is panicking. The most dangerous moment is when prices are soaring and everyone feels like a genius. That's when investors abandon logic. That's when they convince themselves that this time is different, that the rules don't apply anymore, that the trend will continue forever. And that's precisely when the market punishes them most severely. Think about what happens in your own mind when your investment is up 200%, 300%, 500%. You start feeling invincible. You start thinking, why would I sell now? It's going to keep going up. You see other people online talking about their gains, predicting even higher prices, and you don't want to be the fool who sold too early. This psychological trap, this fear of missing out combined with greed, has destroyed more wealth than any market crash ever could. Because the crash itself isn't what destroys wealth. It's the decision to hold through the crash when all the warning signs were flashing red. So let me give you the framework that will protect you. When we see industrial users stepping back from the market because silver has become too expensive for their manufacturing processes, that's a warning sign. When mainstream media that has been skeptical for years suddenly turns uniformly bullish and starts telling everyone to buy silver, that's a warning sign. When your neighbors and relatives who have never invested in anything start asking you how to buy silver coins, that's a warning sign. When speculative futures positioning reaches extreme levels, when everyone who wants to be long is already long, that's a warning sign. These aren't random indicators. They're based on observable patterns that have repeated throughout market history, the mathematical reality behind peak formation, and why momentum becomes your enemy at the top. Now let me show you something that most investors never grasp until it's too late. The mechanics of how market tops actually form. This isn't mystical. This isn't unpredictable. It's mathematics combined with psychology. And once you understand it, you'll never look at price charts the same way. A market top doesn't happen when things look bad. It happens when things look perfect. Every indicator is bullish. Every news headline confirms your thesis. Every chart pattern suggests higher prices ahead. Your account balance is growing every single day. And that's exactly why tops are so dangerous. They seduce you into believing the impossible can continue indefinitely. Here's the mechanism. In the early stages of a bull market, you have strong fundamental demand. Industrial users need silver. Investors recognize undervaluation. Smart money accumulates quietly. Prices rise steadily but not dramatically. This phase can last months or even years. Then, as prices continue rising, momentum attracts attention. Speculative money flows in. Traders who don't care about fundamentals start buying because the trend is up. Media begins covering the story. Retail investors, people who have never owned silver before, start participating. And this is where the acceleration happens. Each new wave of buyers pushes prices higher, which attracts the next wave of buyers, which pushes prices even higher. This feedback loop creates what we call a parabolic move, where the price chart literally looks like it's going vertical. Daily gains that used to be 1% or 2% turn into 5%, 7%, 10%. Everyone watching feels overwhelming fear of missing out. Everyone already in feels like a genius. And here's the critical point. At the peak of this parabolic move, when everyone feels maximum confidence and maximum greed, you have a mathematical problem that most people never recognize until it's too late. The problem is this. When everyone who wants to buy has already bought, when the last skeptic has capitulated and entered the market, when positioning is at maximum levels, there's nobody left to push the price higher. Think about it logically. If 95% of traders are already long, if every investment fund is already allocated to silver, if retail investors have already committed their capital, where does the next wave of buying come from? It doesn't. And without new buyers, the price can't continue rising. But here's where it gets truly devastating. When the momentum breaks, when that first big down day happens after weeks of relentless gains, all of those momentum traders who bought simply because the price was going up suddenly realize the trend has changed. And they all try to exit at the same time. The speculative money that flowed in over weeks flows out over days. The parabolic rise becomes a parabolic fall. And most retail investors, convinced that this is just a temporary pullback, hold on and watch their wealth evaporate. Let me give you a personal question to consider. If silver has risen from $30 to $150 over 18 months, do you honestly believe that rise represents a new permanent price level? Or do you think it's more likely that silver went too far, too fast, and will eventually correct back towards some mean? The correct answer, the intellectually honest answer, is that extreme moves in both directions tend to correct. The market overshoots on the way up just as it overshoots on the way down. And your job as an intelligent investor is to recognize when the overshoot has happened and position yourself accordingly. Now, I can already hear the objections forming in your mind, but Milton, silver is different. The fundamentals justify much higher prices. Supply is constrained. Demand is exploding. Government money printing means silver could go to $300, $500, even $1,000. And you know what? You might be right about the long term. Over the next decade, silver might very well reach those levels. But that doesn't mean it goes there in a straight line. It doesn't mean you should hold through a 60% correction just to catch the next leg up. That's not investing. That's hope disguised as strategy. I spent my entire career arguing for free markets, for letting prices discover their natural levels without government interference. And one of the fundamental truths about free markets is that they oscillate. They don't move in straight lines. They overshoot, they correct, they test, they consolidate. Understanding this isn't bearish, it's realistic. And building a strategy around this reality is how you actually preserve and grow wealth instead of just watching numbers on a screen. Consider what happened with government monetary policy in the early 1980s. I was deeply involved in policy discussions during that period, and I watched as Paul Volcker raised interest rates to devastating levels to break the back of inflation. Silver crashed from $50 to under $10. Was that predictable? Not in specifics, but in principle, yes. Extreme situations provoke extreme responses, and extreme responses create reversals. Right now, in 1995, we're in a relatively stable period. But I know that future periods of monetary instability will create similar dynamics. Silver will rise dramatically, governments and central banks will eventually respond, and those responses will create volatility and corrections that destroy unprepared investors. The scaling strategy I'm advocating, selling portions of your position as warning signs accumulate, isn't about perfectly timing the top. It's about ensuring you actually realize gains instead of just watching them appear and disappear on paper. If you sell 20% at $100 and silver goes to $125, you still have 80% participating in that move. If you sell another 20% at $125 and silver goes to $150, you still have 60% participating. But, and this is crucial, if silver peaks at $150 and crashes to $75, you've already locked in substantial profits on 40% or 60% of your holdings. You've actually made money that can't be taken away from you. The action framework that separates successful exits from devastating mistakes. So let me give you the precise implementation strategy, the actual steps you need to take right now, today, to prepare for the exit that's coming. Because here's something I learned through decades of observing markets. The time to prepare your exit strategy is not when you need it. It's now. It's when you're calm, rational, and not being influenced by extreme price movements in either direction. First, you need to establish your baseline position size. Write down exactly how many ounces of silver you own right now. Don't round it, don't estimate, get the exact number. Then divide that number by 5. That's your tranche. Size, 20% of your total position. This is the amount you'll sell at each predetermined signal level. The reason we use 5 tranches is mathematical and psychological. It's enough increments to ensure you don't exit too early if the bull market extends further than expected, but few enough that you're substantially reduced before any potential crash. Second, create what I call your warning sign checklist. Every single week, I don't care how busy you are, this is your wealth we were talking about, you're going to evaluate 8 specific indicators. Number 1, retail mania. Are coin dealers reporting lines out the door? Are premiums over spot price rising to extreme levels? Number 2, media capitulation. Have mainstream financial outlets gone from skeptical to uniformly bullish? Number 3, speculative positioning. Check the commitment of traders' report for extreme net long positions among large speculators. Number 4, industrial demand signals. Are you seeing news reports of manufacturing delays or project cancellations due to high silver prices? Number 5, new supply responses. Are previously unprofitable mines reopening or ramping up production? Number 6, government intervention discussions. Are policymakers talking about market stabilization measures? Number 7, Technical breakdown: has the parabolic price advance broken down with a sharp high volume reversal? Number 8, sentiment extremes. Are sentiment surveys showing 90% plus bullish readings with essentially no bears remaining? Here's how you implement this systematically. Maintain a simple spreadsheet. Each week you review these 8 indicators and mark each one as either present or absent. Right now, in 1995, as I'm speaking to you, none of these would be present in silver. The market is quiet, stable, unremarkable. But in future bull markets, as each indicator begins appearing, you track it. When 3 indicators are present and silver has reached your first price target, let's say $100 is a hypothetical future level, you execute your first tranche sale. You don't think about it, you don't debate it, you don't check online forums to see what other people think. You execute the plan. Now here's where most people fail. They create the plan but then abandon it when emotions run high. When silver is at $120 and you've already sold your first tranche at $100, every fiber of your being is going to scream, you sold too early. You're going to see other investors posting about their gains. You're going to see analysts predicting $200, $300 silver. And you're going to be tempted to abandon your plan and hold everything else for the ride higher. This is the moment that destroys most investors, because what you're experiencing isn't rational analysis. It's FOMO, it's greed, it's the psychological bias toward recency where whatever is happening right now feels like it will continue forever. This is why the plan must be mechanical. You've predetermined your exit points based on warning signals, not on price targets alone. Price is important, but it's the accumulation of warning signs that tells you the market structure is becoming unstable. When you have 5 warning signs present, maybe industrial users are cutting back. Maybe media has turned uniformly bullish. Maybe speculative positioning is at extremes. Maybe retail mania is evident. Maybe new supply is starting to hit the market. That's when you execute your second tranche, regardless of whether silver is at $125, $130, or $140. The specific price is less important than the market structure. Let me address another painful question that many of you are probably confronting. What if I sell too early and miss the real top? What if I execute my full exit strategy and silver keeps going for another 6 months? First, understand that this is guaranteed to happen to some degree. You will not sell at the exact top. Nobody does except by pure luck. But here's the reframing you need. Selling too early and keeping your profits is infinitely better than selling perfectly on the way down after giving back 60% of your gains. Your goal isn't perfection. It's wealth preservation and realization. I want you to think about this mathematically. If you buy silver at $30 and sell your entire position in tranches between $100 and $160, your average exit price might be around $130. Even if silver subsequently peaks at $180, you've still captured a 333% gain on your average exit price. That's generational wealth. That's life-changing money. And you've locked it in. It's real. It's realized. Nobody can take it away from you. Now compare that to the investor who buys at $30, watches it go to $180 and holds because they believe it's going to $300, then watches it crash back to $70. They had paper profits of 500%, but they realized profits of 133%. Which investor actually made money? Which investor can use those profits to buy real assets, fund their retirement, change their life circumstances? The final component of this action framework is deciding what you do with the proceeds. This is critical because if you sell silver at $130 and then park the money in a checking account earning 0% interest, while inflation runs at 4%, you're losing purchasing power every single day. You need a deployment strategy for your exit proceeds. The options are: 1, temporary safety in short-term treasury bills while you wait for the next opportunity. This preserves capital and earns a modest return while keeping you liquid. 2, rotation into other hard assets that haven't peaked yet. Perhaps gold, perhaps certain commodities, perhaps real estate in markets that haven't yet appreciated. 3, patient, waiting to buy silver back at lower prices after the correction. This is my preferred approach for those with discipline, as it allows you to dramatically increase your ounce position without adding new capital. What you absolutely cannot do is sell your silver and then, when it drops 40%, panic and think you made a mistake. The crash after a parabolic top is not evidence that you were wrong to sell. It's confirmation that you were right. It's validation of your analysis. And if you've prepared mentally for this, if you've told yourself in advance, I know I'll feel regret when I sell and the price continues up, and I know I'll feel vindication when it crashes, then you can navigate the emotional volatility without making impulsive mistakes. Let me leave you with this final thought, and I want you to really internalize it. The silver bull market that's coming, whether it begins next year or 5 years from now, will create extraordinary wealth, but it will create that wealth only for investors who understand that bull markets end. They always end, without exception. Throughout all of economic history, every single parabolic price movement has eventually corrected. Not because the fundamentals were wrong, not because the market was manipulated, but because markets oscillate, because extreme positions eventually reverse, because human psychology swings from fear to greed and back again. Your task, your responsibility to yourself and your family is to recognize this truth now while you're calm and rational. Build your exit strategy now. Create your warning sign checklist now. Divide your holdings into tranches now. Make the commitment to yourself now that you will execute the plan when the signals appear, regardless of how the market feels in that moment. Because in that moment, when silver is making new highs every day, when everyone around you is euphoric, when analysts are predicting $300 and beyond, in that moment, you will not want to sell. Every instinct will tell you to hold. That's when you pull out the plan you created today. That's when you look at your warning sign checklist and see 7 out of 8 indicators flashing red. That's when you execute your predetermined strategy, not because you want to, not because it feels good, but because you know with intellectual certainty grounded in decades of market history and economic theory that capturing gains is more important than chasing perfection. The greatest tragedy in investing isn't missing out on gains, it's capturing gains on paper and then watching them disappear because you didn't have the courage and foresight to protect them. Don't let that be your story. Build your exit strategy today. Execute it with discipline tomorrow and walk away from the next silver bull market with realized wealth that changes your life forever. That's not pessimism, that's wisdom. And wisdom, my friends, is what separates wealth that lasts from wealth that was just an illusion on a computer screen.